When Warren Buffett speaks, the world listens. They call him the Oracle of Omaha for a reason. For decades, his wisdom has guided investors. But what happens when the master changes his tune? The signals coming from Buffett and Berkshire Hathaway are not just whispers of caution, they are a blaring alarm. We are seeing unprecedented moves from Buffett. The man who loves to buy American businesses is now selling them at a historic pace, even in beloved stocks like Apple. These are monumental shifts in strategy that have sent shockwaves through the financial community. What does Warren know that we don't? Buffett has an uncanny track record of being right. His letters to shareholders often predict major market shifts with stunning accuracy. Ignoring it could be a perilous mistake for any investor. It says that one of the world's most successful investors cannot find good places to put his money. When its cash pile grows to record levels, it means he would rather earn a tiny return on cash than risk it in an overvalued market. This is the core of the warning, and it is a story that every investor needs to understand right now. Let's get down to brass tacks. The numbers here are staggering. In 2024, Warren Buffett and Berkshire Hathaway slammed on the brakes, selling off $133 billion in stocks. This resulted in net sales of $127 billion. This is the most aggressive selling we have ever seen from Berkshire Hathaway. Instead, it went into cash. Berkshire Hathaway's cash hoard has exploded, reaching a record of $334.2 billion. Buffett is choosing to sit on a mountain of cash, earning very little rather than deploying it into the market. The fact that he is choosing not to invest is the real warning. This is the ultimate vote of no confidence from the world's most respected investor. He is building a fortress of cash, preparing for a storm that he sees gathering on the horizon. So, what is driving this unprecedented caution from the Oracle of Omaha? It is not just a gut feeling. A key piece of the puzzle is a metric that Buffett himself has praised as the best single measure of where valuations stand at any given moment. It is called the Buffett indicator. The calculation is simple. It takes the total market capitalization of all U.S. stocks and divides it by the country's gross domestic product. In essence, it compares the value of the stock market to the size of the underlying economy. It is a reality check, a way to see if market hype has detached from economic fundamentals. Right now, that indicator is not just flashing red, it is screaming a warning. As of late 2024, the Buffett indicator surged to an all-time high of 230%. To understand how extreme that is, we need to look at history. The last time this metric reached a dramatic peak was back in March 2000. Right at the height of the dot-com bubble. Back then, it hit what was considered a frightening level of 175%. What followed was a brutal market crash that wiped out trillions of dollars in wealth. Today's level of 230% blows that past record completely out of the water, suggesting the market is more overvalued now than it was during one of the most infamous bubbles in financial history. Warren Buffett has always been clear about the danger of overpaying, even for a wonderful business. He once said that future returns are always affected by current valuations. His point is that if you buy into the market when prices are sky high, your potential for future growth is severely limited, even if the companies you own continue to do well. An overpriced stock can lead to years of disappointing returns or even worse, significant losses when the market eventually corrects and returns to more sensible valuation levels. The Buffett indicator is telling us that, as a whole, the market is severely overpriced. This brings us to the urgent question on every investor's mind. Are we on the brink of a major market downturn? When you connect the dots, record cash piles, historic stock selling, and a valuation indicator at an all-time high, the picture becomes alarmingly clear. These are not isolated events. They are interconnected pieces of a warning puzzle assembled by one of history's greatest investors. The recent volatility in the markets, with major indexes pulling back from their highs, suggests that Buffett's concerns may already be starting to materialize. The storm he has been preparing for could be closer than many think. Let's examine Berkshire Hathaway's cash. It's the largest corporate cash pile in modern history. By the close of 2024, Berkshire Hathaway's balance sheet showed a staggering $334.2 billion in cash and short-term investments. This is a financial fortress, a vast reservoir of capital that Buffett and his team are deliberately choosing not to deploy into the stock market. This cash position did not appear overnight. It has been building methodical. Throughout 2024, as the S&P 500 continued its impressive climb, Buffett was quietly moving in the opposite direction. This hoard now accounts for over 28% of Berkshire's total asset value, the highest percentage it has been in more than 3 decades. While it is true that Berkshire still holds a massive stock portfolio, the decision to let the cash component swell to such a historic proportion speaks volumes. He believes that the risk of capital loss in the current market environment is greater than the risk of missing out on potential gains. He would rather preserve his capital and wait for a better opportunity than gamble it on what he perceives to be overpriced assets. If the mountain of cash is one side of the coin, the other side is how that mountain was built. It was built through the most aggressive and sustained period of selling in Berkshire Hathaway's history. During the first 9 months of the year, Berkshire sold off a stunning $133 billion worth of its stock holdings. This was a broad and decisive retreat from the market. This action is profoundly significant because it goes against the very grain of Buffett's celebrated investment philosophy, and selling in quantities that suggest a fundamental disagreement with the market's direction. But the Oracle of Omaha was quietly heading for the exits. This is a classic Buffett move, being fearful when others are greedy. A clear signal that he did not trust the rally's sustainability. It logically suggests that he may be anticipating a period of particularly weak returns, or even a significant downturn in 2025. Perhaps the most startling detail is which stocks Berkshire chose to part with. The headline grabber was the decision to trim Apple, Berkshire's largest investment. For years, Buffett has lauded Apple as Berkshire's single best business. News broke that Berkshire had started to sell shares of Apple, sending a shockwave through the investment community. If Buffett is willing to trim his position in one of the best companies in the world, what does that say about his view on the rest of the market? It reinforces the idea that his concern is not about the quality of individual businesses, but about their price. This action is a real-world application of his principle that future returns are dictated by current valuations. This move is a lesson in disciplined, unemotional investing. Buffett is demonstrating that no investment is untouchable. His primary allegiance is to the principle of value. This is a clear warning to investors who may be holding on to high-flying tech stocks without considering their current price tags. Why isn't Buffett buying? With a $334 billion war chest, he refrains from acquisitions. He's struggling to find anything worth buying at a fair price. The well of attractive opportunities appears to have run dry. When markets are expensive, bargains shrink dramatically. Buffett has built his empire by refusing to overpay. He is content to wait on the sidelines until a fat pitch comes his way. This inactivity is a warning in itself. The lack of major purchases suggests a widespread overvaluation. Buffett's refusal to buy is a silent critique of the market's current valuation levels. His strategy of hoarding cash suggests he is preparing for market turmoil. So let's connect all the dots. The historic cash pile, the record-breaking stock sales, and the trimming of favorite holdings like Apple are not separate events. They are all components of a single coherent strategy rooted in extreme caution. Buffett is not explicitly shouting "sell everything" from the rooftops. His actions, however, paint a picture of an investor who believes the market is fraught with risk and devoid of compelling opportunities. He is building a defensive fortress not for a minor skirmish but in preparation for a potential major storm. The sheer scale of his moves elevates this beyond normal portfolio management into a significant market-wide warning. It is essential to understand the mindset behind this strategy. Buffett is playing the long game. He is not concerned with maximizing returns in a single quarter or even a single year. His primary goal is the preservation and long-term compounding of capital. From this perspective, avoiding a large potential loss is far more important than capturing the last leg of a bull market rally. The current strategy is the epitome of risk management. By converting overpriced stocks into cash, he is taking risk off the table and giving himself maximum flexibility to act when valuations become more reasonable. He is trading short-term opportunity for long-term security and potential. For the beginner investor, this is a profound lesson. The temptation to chase a rising market, driven by a fear of missing out, is immense. But Buffett's actions teach us the value of discipline and patience. They show that sometimes the smartest move is to do nothing, to resist the urge to buy into the hype. His current stance serves as a powerful counter-narrative to the prevailing market optimism. It suggests that investors should be asking tough questions about the prices they are paying for stocks, and whether those prices are justified by underlying business fundamentals. It is a call to prioritize caution over greed. Ultimately, Berkshire's cash pile is not just a pile of money, it's a barometer of opportunity. Right now, that barometer is signaling a severe lack of attractive prospects. It implies that Buffett believes better opportunities will emerge in the future, likely at much lower prices. This is the crux of his warning. He is not predicting the exact timing of a crash, which is honestly an impossible task for anyone. Instead, he is positioning himself based on probabilities and value. His actions tell us that, in his expert assessment, the probability of a market downturn is high enough to warrant the most defensive stance he has taken in decades. The Buffett indicator is a powerful metric that Buffett called the best single measure of valuations. The concept is simple. It compares the total value of all publicly traded stocks in the U.S. to the country's total economic output, measured by GDP. This ratio shows if the market is cheap, fairly priced, or expensive. If the stock market grows faster than the economy, investor expectations may be detached from reality. The Buffett indicator acts as a reality check. A ratio around 100% is fair value. Below 100% suggests stocks are undervalued. Above 100% indicates overvaluation. It's a gauge of market temperature. It provides historical context for valuations. Am I paying a reasonable price? The Buffett indicator is signaling unprecedented levels, rocketing to 230% in late 2024. This means the U.S. stock market's value is more than double the nation's annual economic output. This is uncharted territory. Historically, anything above 120% signals caution. This is the very definition of a market bubble. It highlights why Buffett is selling stocks and hoarding cash. The Buffett indicator serves as a crucial objective warning. The current market is more expensive than it has ever been. The potential for significant losses is very real. To grasp the danger of today's sky-high Buffett indicator, let's revisit the dot-com bubble. In March 2000, the Buffett indicator hit a then-record 175%, a level that shocked investors and signaled mania. The bubble burst, wiping out trillions as the Nasdaq plunged nearly 80% and the S&P 500 fell almost 50%. That historic warning was clear. Extreme valuations can lead to devastating losses. Today, the Buffett indicator sits at 230%, far above the dot-com peak, suggesting even greater risk. The lesson, no matter how exciting the market, paying too much can erase years of gains in a flash. The Buffett indicator's warning boils down to one thing: valuation is everything. Overpaying, even for great companies, sets you up for disappointment. Buffett's own actions, selling stocks and hoarding cash, show he refuses to play when prices make no sense. A return to average valuations could mean real pain for investors who ignore the risks. In a world of hype and speculation, ask yourself, is the price reasonable? The Buffett indicator says no. Now is the time for caution, quality, and a margin of safety, just as Buffett himself is doing. After years of relentless gains, cracks finally appeared in early 2025. The Dow dropped 8%, the S&P 500 fell over 9%, and the Nasdaq tumbled nearly 14%. Erasing months of progress. This correction arrived just as Buffett's warnings and cash buildup reached a peak. The easy money era vanished, replaced by fear and a new focus on risk. For many, this was their first taste of real volatility. The market stumble is a wake-up call. Even the strongest rallies can reverse. The question now, are these just cracks or the start of something bigger? Buffett's playbook in past crises is simple: patience, preparation, and bold action. He sat out the dot-com bubble, then bought bargains after the crash. In 2008, he waited for panic, then invested billions in blue-chip companies at fire-sale prices. His current cash pile isn't just defense, it's ammo for the next big buying opportunity. Buffett's strategy: sell when markets are euphoric, wait for fear, then buy when value returns. He's not rushing in after a minor dip, he's waiting for true bargains. History shows Buffett turns market panic into profit. If history repeats, a return to average valuations could mean a 40% drop in major indexes. That's not alarmism, it's what happened after past bubbles. Buffett's cash hoard positions him to buy when others are forced to sell. For most investors, such a decline would be painful. But knowing the risk is the first step to preparing. The lesson: don't be complacent in an overvalued market. When valuations stretch this far, the road back is often long and rough for the unprepared. A key reason this market feels precarious is the growing disconnect between soaring valuations on Wall Street and the economic realities on Main Street. While the stock market shattered records, many households grappled with inflation and rising interest rates. This divergence, fueled by mega-cap tech stocks and speculative sentiment, creates a fragile foundation. Warren Buffett, attuned to the real economy, may be seeing signs of a slowdown not yet reflected in earnings. This disconnect is dangerous, creating a wealth effect in reverse. The Buffett indicator measures this disconnect, showing a market far ahead of the supporting economy. History shows the stock market cannot defy economic gravity forever. The recent market stumble signals this link reasserting itself. Buffett's warning is a call to pay attention to this dangerous disconnect. In the face of market volatility, turn to Warren Buffett's enduring principles to guide you through uncertainty. The most fundamental is the 10-year test. Buffett stated, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This cuts through short-term noise, shifting your mindset to long-term value creation. It's the antidote to panic selling. Before buying, ask, do I believe in this company enough to be a partner for a decade? Would I hold if the market shut down for 10 years? If no, you're speculating, a dangerous game. This steers you toward durable businesses. It encourages deep research. In a market correction, owning companies you believe in provides fortitude. View downturns as opportunities to buy more at better prices." History provides lessons for navigating markets, and Warren Buffett's career is a living textbook. The key lesson is the power of patience and discipline. Buffett stuck to his principles, refusing to invest in what he couldn't understand. This highlights the importance of defining your circle of competence. Another lesson is the danger of leverage. Buffett said, "It's insane to risk what you have and need for something you don't really need." His success boils down to margin of safety. He is patiently waiting on the sidelines until it returns. So, what are the concrete steps a beginner investor should take right now, in light of Buffett's ominous warnings and the market's recent shakiness? The first and most important step is not to panic. Making rash decisions based on fear is almost always a mistake. Instead, use this as an opportunity to review your portfolio with a calm and rational mind. Look at each holding and apply Buffett's 10-year test. Is this a company you want to own for the long haul? Is it a high-quality business with a strong competitive advantage? If not, this might be a good time to consider trimming positions in your most speculative, low-quality holdings and reallocating that capital to safer ground. Second, consider raising some cash. You do not have to sell everything, and you should not try to time the market perfectly. However, emulating Buffett by increasing your cash position can be a very prudent move. Having cash on the sidelines serves two critical purposes. Defensively, it reduces your portfolio's volatility and protects some of your capital from a potential market decline. Offensively, it provides you with the dry powder needed to take advantage of opportunities that may arise if the market falls further. A 10%, 20%, or even 30% cash position can provide both peace of mind and future firepower, turning you from a potential victim of a downturn into a potential beneficiary. Third, focus on quality and value. In a nervous market, the speculative froth is the first thing to get blown away. Companies with weak balance sheets, no profits, and unproven business models get hit the hardest. This is the time to gravitate toward the opposite: established, profitable companies with strong balance sheets, consistent cash flow, and a history of navigating economic downturns. These are often dividend-paying, blue-chip stocks in defensive sectors like consumer staples, healthcare, and utilities. They may not offer the explosive growth of tech darlings, but their resilience can provide crucial stability to your portfolio when a storm hits. Look for value, not for glamour. Finally, continue to invest, but do it systematically. One of the best strategies for a volatile or declining market is dollar-cost averaging. This means investing a fixed amount of money at regular intervals regardless of the market's ups and downs. When the market falls, your fixed investment buys more shares, lowering your average cost over time. This disciplined approach removes emotion from the equation and ensures you are buying when prices are lower. Combining dollar-cost averaging with a focus on high-quality companies and a healthy cash reserve creates a robust, Buffett-inspired strategy that can help you not just survive the current uncertainty, but thrive in the long run. The message from Warren Buffett is clear. Berkshire Hathaway holds a massive cash pile. They're aggressively selling stocks. The Buffett indicator is flashing a warning. Cracks are appearing in the market. The dots connect to caution. Don't panic, be prudent. Buffett's actions are risk management. Be fearful when others are greedy. Prioritize capital preservation. Be a cautious investor. Fortify your financial defenses. Focus on resilient businesses. Survive the storm. Capitalize on opportunities. Return to sound investing principles. It is natural to view the prospect of a market downturn with fear and anxiety. No one enjoys watching the value of their portfolio decline. However, the most important lesson from Warren Buffett's playbook is to completely reframe this perspective. For the prepared investor, a market correction is not a crisis, it is an opportunity. It is the moment when the irrational exuberance of the bull market finally gives way to fear, and in that fear, prices become disconnected from long-term value. This is the environment where fortunes are made. The entire purpose of Buffett's defensive posture, the selling, the cash hoarding, is to prepare for this exact moment. Think of the current situation as a grand sale that has not started yet. Right now the store is crowded and everything is marked up to exorbitant prices. Buffett has already left the store and is waiting outside with a huge amount of cash. He is waiting for the inevitable clearance event when quality merchandise will be marked down by 30%, 40%, or even 50%. This requires a fundamental shift in mindset. Instead of fearing lower prices, you should learn to welcome them as a chance to buy more of the great businesses you want to own for the long term, but at much more attractive entry points. Your cash on the sidelines is your ticket to this future sale. This perspective changes everything about how you view the market's day-to-day movements. A red day on the market is no longer a source of pain, but a sign that opportunities are getting closer. It transforms you from a passive victim of market volatility into an active and patient hunter of value. This is precisely the mindset that has allowed Buffett to make his most legendary investments during times of maximum pessimism, such as the 2008 financial crisis. He was able to act decisively because he had the capital ready and, just as importantly, he had the psychological fortitude to buy when everyone else was panicking. Therefore, the ultimate message embedded in Buffett's warning is one of long-term optimism, rooted in short-term realism. He is realistic about the current overvaluation and the high probability of a correction, but he is profoundly optimistic about the long-term prospects of American business and his ability to buy into it at a much better price in the future. For every investor listening to his warning, the goal should be to adopt this same duality. Be prudent and defensive today so that you can be bold and offensive tomorrow when the real bargains appear. As we conclude, let us look to the future. The warnings from Warren Buffett and the recent market turbulence are not an endpoint, but a turning point. They signal a transition from an era of easy money and speculative excess to a more challenging environment where skill, discipline, and patience will be paramount. The investors who succeed in the coming years will be those who heed the lessons of history and the wisdom of masters like Buffett. They will be the ones who build their portfolios on a foundation of quality, value, and a long-term perspective, rather than on the shifting sands of market sentiment. Your task now is to become that investor of tomorrow. Start by building a simple, robust plan based on the principles we have discussed. Define your long-term goals. Commit to a strategy of regular systematic investing such as dollar-cost averaging, which turns volatility into an advantage. Create a watch list of high-quality companies you would love to own for the next decade and patiently wait for a market downturn to offer you a more attractive price. This proactive approach replaces fear with a sense of purpose and control, empowering you to navigate whatever the market throws your way. Remember that investing is a marathon, not a sprint. There will be periods of exhilarating gains and periods of painful losses. The key to finishing the race successfully is to never let either extreme dictate your strategy. The current warnings from Buffett are a reminder to slow down your pace, check your map, and ensure you are prepared for the difficult terrain that may lie ahead. By doing so, you are not just protecting yourself from a potential crash, you are positioning yourself to accelerate when the path becomes clear again. This is the essence of strategic, intelligent investing. Ultimately, the story of Warren Buffett's 2024 warning is a timeless one. It is a story of discipline versus hype, of patience versus greed, and of value versus price. The market will fluctuate, bubbles will inflate and burst, but these core principles will endure. By understanding the signals Buffett is sending and integrating his time-tested wisdom into your own approach, you can chart a course to navigate the current uncertainty and build lasting wealth over the long term. The future is uncertain, but with the right map and a steady hand, you can confidently steer toward your financial destination.